Have you ever dreamed of creating passive income streams that could eventually replace your job? Or wondered how ordinary people build multi-million-dollar real estate portfolios starting with just one property? While stocks and bonds fluctuate wildly, rental properties have created more millionaires than perhaps any other investment vehicle. Yet many people hesitate to get started, intimidated by myths about needing large amounts of cash or specialized knowledge. Brandon Turner, an investor who built a portfolio of over 100 units, argues that rental property investing is more accessible than most people realize if you understand the right strategies, financing methods, and property selection criteria. The book on rental property investing provides a blueprint for building wealth through real estate, from finding your first deal to scaling a portfolio that generates truly passive income. We're going to explore this animated book summary about turning properties into lasting prosperity. Before we get into the first idea, wouldn't it be better if you had a platform specially designed for visual learners like you? That's exactly what BookWatch offers. Discover thousands of animated book summaries, just like the one you are currently watching. You can also get personalized advice. Our AI expert is trained to know each book in our library, so you can ask him how to apply every book in your unique life situation. Stay focused by taking notes effortlessly. Press the button and let BookWatch capture key ideas along with their timestamps, so you can review and expand on them later. Not sure what to read next? Just tell our AI what you want to learn or your challenges, and it'll recommend the best books tailored to your needs. Track your journey with gamified progress. Earn streaks and achievements every time you dive into a new book. Click the link in the description to access BookWatch today. If you are enjoying our free content on YouTube, don't forget to like this video and subscribe to our channel. Now let's continue our video. Idea 1. Why invest in rental properties? Investing in rental properties is a popular choice for those looking to build wealth, and there are several compelling reasons why. Firstly, rental properties can provide a steady stream of cash. This means that every month, tenants pay rent, which can cover the costs of the mortgage and expenses, with the potential for extra money that goes directly into the investor's pocket. Over time, the value of real estate typically increases. As property values go up, so does the potential for an investor to make money from selling the property at a higher price than they bought it, or simply benefiting from the increased value as it reflects in their net worth. Rental properties also offer the benefit of someone else paying down the mortgage. With each rent payment, a portion goes to pay down the loan on the property, which means the investor builds equity without personally contributing to the payment. Perhaps one of the most attractive aspects is the tax advantages that come with owning rental property. There are deductions available for a variety of expenses, including mortgage interest, property tax, operating expenses, depreciation, and repairs. These can reduce the amount of income tax that the investor has to pay. Moreover, rental properties can be a source of greater control over your investment compared to other types like stocks or mutual funds. An investor has the opportunity to influence the performance of their property through improvements, choosing the right tenants, and effective management. Ultimately, the goal of investing in rental properties is to gain financial freedom. With careful selection, management, and perhaps a bit of luck, rental properties can become a significant asset that generates income without the need to trade time for money, offering a pathway to retire early or to invest in even more properties. Idea 2. The 4 wealth generators of real estate. Rental properties are often seen as one of the best ways to build wealth for 4 main reasons. First, they generate cash flow, which is the money left over each month after all of the expenses and mortgage payments have been made. Think of this like getting a paycheck from your job, but this paycheck comes from your property's tenants. This regular income can provide financial stability and extra cash that you can reinvest. Second, properties usually increase in value over time, a concept known as appreciation. As your property's value grows, so does your potential profit if you decide to sell it down the road. Even while you own the property and it's providing cash flow, its worth is likely climbing, kind of like a savings account that grows without you adding money to it. The third wealth generator is the loan paydown. If you have a mortgage on your property, each payment you make isn't just covering interest. The majority of it also goes to reducing the principal amount of the loan. This means your tenants are essentially helping you pay off the property over time, which is like someone else contributing to buying you an expensive asset. Lastly, owning real estate comes with tax benefits. There are various deductions available, such as interest payments, operating expenses, property taxes, and depreciation. Depreciation is a way to account for the perceived decrease in value of the property over time due to wear and tear, even if the actual market value is going up. These tax advantages can save you money, leaving you more of your investment income to use or invest elsewhere. Together, these four elements work to make real estate a powerful vehicle for growing your wealth over the long term. Earning cash now, expecting your property to be worth more later, having someone else pay off the property for you, and enjoying tax breaks along the way presents a compelling package for anyone looking to invest. Idea 3. Planning your real estate strategy. When planning your real estate strategy, it's like setting up a roadmap for a long journey. You need to know where you stand financially before you even think about buying properties. It starts with your current budget, debts, income, and savings. You should have a clear picture of this, because jumping into real estate without understanding your own money is like trying to sail a boat with no knowledge of the sea. Next, it's about setting goals. This isn't just about saying, "I want to be rich." It's more specific, like deciding how many properties you want to own in 5 years, or the amount of cash flow you need to quit your job. These goals should be realistic and something you can actually work towards. Then, you've got to decide on what type of real estate fits your goals. Some people like the idea of single-family homes, while others prefer apartment buildings or something else. Each type has its perks and drawbacks, so you pick what aligns with your goals, personality, and abilities. The strategy piece also involves how you plan to find these properties. It's not enough to just look at listings online or wait for a real estate agent to call you with deals. You might need to get creative, look in different areas, or use different methods to find the right property. Once you find a potential property, knowing how to pay for it is a part of your strategy too. Are you going to save up and buy with cash, get a mortgage, or use a more creative approach to finance the purchase? This step is critical because it often dictates what kind of properties you can afford and how quickly you can grow your portfolio. Managing the property is another key component of your plan. Will you take on being a landlord with all the responsibilities that come with it, or will you hire a management company to handle the day-to-day tasks? Your time and skills will play a large role in this decision. As you work through each of these parts of your strategy, remember to stay flexible. Real estate markets change, personal situations evolve, and opportunities come up when least expected. Your strategy is a guide, but it should never be so rigid that you can't adapt to new information or circumstances. The better prepared you are with a solid plan, the more successful you're likely to be in the world of rental property investing. Idea 4. Types of rental properties. When exploring rental property types, you'll come across different kinds of homes and buildings designed to fit various investor needs and strategies. Single-family homes are one option, known for being standalone structures that typically cater to small families or couples. They can be a great starting point for new investors because they're often easier to understand and manage. Plus, when it comes time to sell, you might find a larger market of potential buyers, including other investors and people looking for a home of their own. On the flip side, you could look into multifamily properties, which are basically buildings with several units inside. They range from a duplex, which has 2 dwellings, up to larger apartment complexes with potentially hundreds of units. With these, you can house more tenants and therefore potentially pull in more income each month. However, they might require more work to manage, especially as the number of units increases. Another class of rental properties is commercial real estate. These are properties that are meant for business use. You might not dive into these until you have a bit more experience, as they can come with different kinds of challenges and rewards compared to residential properties. And there's also mixed-use properties, which combine residential and commercial spaces. These often have commercial businesses on the ground floor, like stores or restaurants, with apartments up above. This setup can offer a diverse revenue stream, appealing to those who like the idea of tapping into both residential and commercial markets. Of course, in the rental property game, location is super important. Whether you're considering a beachside bungalow or a cozy city apartment, the area can hugely impact your property's appeal and the amount of rent you can charge. Each property type has its own set of pros and cons, costs, and management needs. As you get into this world, you'll learn more about what kind of investment fits your goals, resources, and lifestyle best. Whether you want to be hands-on or hire someone to manage the day-to-day, there's likely a type of rental property that will match what you're looking for. Idea 5. Finding the right real estate market. When looking for a real estate market to invest in, there are several factors to consider that can indicate the potential for rental property success. The first thing to look at is job growth. Areas with increasing job opportunities tend to attract more people looking for work, which can mean a greater demand for housing. Alongside job growth, check the unemployment rate. Lower rates often mean a healthier local economy. Population trends are another key indicator. Markets where more people are moving in rather than out can present great investment opportunities due to higher demand for rental properties. It's also important to consider the types of industries present in the area. Diverse economies with a mix of different job sectors can be more resilient to economic downturns than those dependent on a single industry. Rental yield is a crucial metric. It compares the income generated by a property to its price. Areas with higher rental yields can be more attractive as they suggest your investment could pay off faster. Housing prices themselves are significant. Look for areas where property is affordable for you, but also has room for appreciation. Local laws can play a big role too. Some areas have laws that are more favorable to landlords, making property management easier and less risky. It's smart to look into the current and planned infrastructure, such as new schools, hospitals, or public transport, which can boost property values and desirability. Understand the local tenant market, who rents in the area. Young professionals, families, students. Knowing your potential tenants helps you tailor your investment to meet their needs, which can lead to lower vacancy rates. Lastly, crime rates can affect the appeal of your rental property. Lower crime often means tenants will feel safer, and that can influence their decision to rent and how much they're willing to pay. All of these factors together can help determine if a market is ripe for rental property investments or not. It requires research and sometimes getting to know the area personally or through reliable contacts. That's why many successful investors spend a considerable amount of time analyzing different markets before they jump in. Idea 6. Analyzing deals. Understanding how to analyze real estate deals is crucial for successful rental property investing. It's about figuring out if a property will make enough money to be worth the investment. Here's what you need to consider during the process. First, learn how to calculate the potential income from a property. This isn't just the rent you'll get, but may also include things like laundry services, storage, or parking fees. Once you have an idea of the income, you need to subtract all the costs. These include your mortgage payment, property taxes, insurance, repairs, and management fees, among others. One of the key calculations used in real estate is the net operating income, which is your income minus your operating expenses, but before paying any loans. This figure helps you understand the property's profitability. Another important number is the cash-on-cash return. This tells you how much money you're making on the money you've actually invested. For example, if you put down $20,000 on a property and make $2,000 profit in a year, your cash-on-cash return is 10%. A term you might hear is cap rate, which is the net operating income divided by the property's purchase price. It's a quick way to compare different real estate investments. When digging into the details, also consider the property's future potential. Is the area improving? Could you increase rent over time? Are there opportunities to reduce expenses? All these factors could mean more money in your pocket. Always do your due diligence. This means checking everything about the property before you buy it. Look at the condition of the building, any legal issues, and the local rental market. It's also smart to plan for unexpected costs. Things will break, and you'll have to fix them, so having a buffer in your calculations for these just-in-case scenarios will help you stay profitable. Lastly, don't forget to think about the time you'll spend managing the property. If it takes up too much of your time, it may not be worth the income it's generating. Proper deal analysis is all about reducing risk and making sure you're putting your money into a property that will pay off in the long run. It's not just about the numbers you see on paper today, but also about understanding the market and being savvy about future changes. Idea 7. Financing rental properties. Financing rental properties is a crucial step in the journey of real estate investing. It's all about how you get the money you need to buy the properties you want. There are several ways to do this, each with its own pros and cons. Traditional bank loans often come to mind first. These are the regular mortgages that you can get from a bank or a mortgage lender. Getting approved for these loans usually means you need to have a good credit score, a stable job, and some cash for a down payment. Then there's creative financing, which stretches beyond the boundaries of traditional bank loans. This includes techniques like seller financing, where the person selling the property actually loans you the money to buy it. There are also lease options, which let you rent a property with the choice to buy it later. Another method is using partners to help finance a deal. Partners can bring in different things. Maybe someone has cash, and another person has the time and skills to manage the property. Working together, they can make an investment that would be tough to handle alone. Some investors use home equity lines of credit, often called HELOCs, from a property they already own to get the money they need to buy new ones. It's a way of borrowing money against the value of a house they already own. There's also the option of private money lenders. These are individuals with money to invest who are looking for a better return than they get from a bank savings account or the stock market. They can often provide more flexible terms than a traditional bank. Hard money lenders are similar to private money lenders, but are usually more professional, and their loans are short-term and come with higher interest rates. These are often used for properties that need to be fixed up quickly. Then some investors use government loans, like those from the Federal Housing Administration, FHA, which can have lower down payment requirements but also come with certain rules and restrictions. In real estate investing, it's also common to hear about refinancing. This means you take out a new loan on a property you already own, often to pay off an older loan or to pull out cash from the equity you've built up in the property. The key across all these methods is to understand the terms, rates, risks, and potential benefits. Each way of financing a property comes with its own set of rules and requirements, and it's up to the investor to find the best fit for their situation. Idea 8. Negotiating deals. When you negotiate real estate deals, your aim is to reach terms that both you and the seller can agree on and that make your investment worthwhile. A big part of this involves understanding the seller's motivation. Ask questions to find out why they're selling the property. This insight can give you leverage in negotiations because you'll know what's important to the seller, whether it's a quick sale, a particular price, or avoiding hassles like repairs. Before you start talking numbers, make sure you've done your homework. Know exactly what the property's worth, what you plan to do with it, and your top dollar. It's not always about offering the lowest price. Sometimes it's about being the easiest buyer to work with. Building rapport with the seller is often underestimated in negotiations. People tend to do business with those they like and trust, show genuine interest in the seller's situation. This can create a more cooperative environment and may lead to a better deal. Once you're ready to discuss terms, be clear about what you can offer. This includes not just the price, but other factors, like the closing date and who pays for what closing costs. For instance, maybe you can offer a faster closing, which could be appealing to a seller in a hurry. Always be ready to walk away if the terms don't meet your requirements. There are plenty of investment opportunities out there, and sticking to your criteria is important for making a good investment. If you can't reach an agreement that makes sense for you, be polite and leave the door open for future opportunities, but move on. Lastly, don't show all your cards too soon. Keep some things back, like your maximum budget or your most desired terms, to give yourself wiggle room. The first person to name a price often sets the baseline for negotiations, so tread carefully. and consider waiting for the seller to make the opening offer. Negotiation is an art in real estate investing that can mean the difference between an okay deal and a great one. It takes practice, patience, and a good understanding of human interactions to consistently negotiate successfully. Idea 9. Managing rental properties. When it comes to managing rental properties, you have two main choices: do it yourself or hire a property manager. If you decide to manage the property on your own, you need to be ready to find and screen tenants, collect rent, conduct maintenance and repairs, and handle any legal issues that may arise, such as evictions. Finding the right tenants is crucial because good tenants can make property management much easier. This involves advertising your property effectively, conducting thorough background and credit checks, and making sure that you follow fair housing laws. Once you have tenants, you need to maintain a professional relationship with them. This includes being clear about the rules and expectations set out in the lease agreement, being available to handle any concerns or emergencies, and regularly checking in on the property's condition. For maintenance and repairs, you should either have the skills to do common repairs yourself or have a reliable team of service professionals on call, like plumbers, electricians, and handymen. Keeping the property in good condition is not only important for tenant satisfaction, but also for maintaining the value of your investment. Collecting rent is a fundamental aspect of property management. This means setting up a system for tenants to pay rent on time and having a policy in place for when rent is late, including any late fees or legal actions you may need to take. If managing properties doesn't suit your lifestyle or skill set, hiring a property manager can be a good alternative, albeit at a cost. This cost typically runs between 8% to 12% of the monthly rental income, but a good property manager can save you time and potentially avoid costly mistakes. They handle the day-to-day operations of your property, which is particularly valuable if you want to invest in rental properties located far from where you live, or if you'd rather focus on expanding your investment portfolio instead of daily management tasks. Regardless of which path you choose, successful management focuses on creating a good living environment for tenants, maintaining the property's condition, and ensuring that the financials are handled efficiently. This will contribute to the overall success of your investment and help you achieve the financial goals that led you to invest in rental properties to begin with. Idea 10. The BRA strategy. The BRA strategy is a real estate investment approach that stands for buy, rehab, rent, refinance, repeat. It allows investors to recycle their capital into multiple properties over time. First, you buy a property that needs work and is typically below market value. Purchasing at a lower price point is key because it gives you room to increase the property's value through renovations and improvements. This fixer-upper aspect is what makes the investment a good candidate for the BRRR method. After buying, you move into the rehab phase. Here you renovate and fix the property with the goal of adding more value than the cost of the renovations. It can range from cosmetic updates to full-scale remodels, depending on the property's state and potential to increase its worth. Once the property is renovated and in good condition, you shift to renting it out. The idea is to find tenants who will provide steady cash flow. This rental income should not only cover all the property's expenses, including the mortgage, taxes, insurance, and maintenance, but also provide additional income on top. After the property is stabilized and generating income, refinancing is the next step. This involves taking out a new mortgage on the property, which ideally is now appraised at a higher value due to the improvements made. The new loan replaces the original mortgage and ideally pulls out some of the equity created through the rehab. This cash can then be used to invest in the next property. The final R stands for repeat, indicating that you should take the cash you've pulled out from the refinance and start the process over again with a new property. It's a way to build a portfolio of cash-flowing properties using a relatively small amount of initial capital to start the cycle. Using the BRRR strategy can be a powerful way to grow a property portfolio quickly, provided you have the skills and resources to effectively implement each step of the process. It requires a good understanding of property values, renovation costs, rental markets, and financing options. Idea 11. Building systems. When you start investing in rental properties, creating systems is a fundamental component that will eventually streamline your operations. Think of systems as your blueprint for handling the various tasks and responsibilities that come with being a landlord or real estate investor. These systems help you to manage your time effectively, maintain consistency in your efforts, and ensure that nothing important falls through the cracks. Building systems means setting up standard procedures for everything you do, from finding and screening tenants to dealing with maintenance requests and conducting regular property inspections. For instance, instead of handling each unit individually, you might develop a tenant screening process that you apply every time you have a vacancy. This could include a set sequence of steps like advertising the property, collecting applications, running credit and background checks, and holding interviews. For property maintenance, instead of reacting to issues as they occur, a system might involve scheduling regular inspections and maintenance checks, which can prevent problems from arising in the first place. This would include having a list of reliable contacts, such as plumbers, electricians, and handymen, who you can call quickly when needed. Having systems also helps with record keeping and financial monitoring. You might use property management software to keep track of rental payments, expenses, and profit margins. This kind of systematization could simplify tax time, as you'd have all your financial information in one place and well documented. A significant part of building systems is automation. By automating certain processes, like rent collection through online payments or setting reminders for lease renewals, you reduce the hands-on time required and minimize human error. Automation not only saves time, but also allows for better scalability, so when you acquire new properties, you can incorporate them into your existing system with relative ease. As you continue to grow your property portfolio, having robust systems in place becomes even more critical. They facilitate delegation and make it possible to hand over tasks to others, such as a property management team, without losing the quality and consistency you have established. Good systems are the backbone of efficiency and can significantly contribute to the long-term success of your rental property investments. Idea 12. Dealing with difficult tenants. Handling difficult tenants is one of the inevitable challenges of rental property investing. It's important to approach these situations with a mix of firmness, professionalism, and understanding. Start by setting clear expectations from the start with a strong lease agreement. This contract should lay out rules about rent payment, property care, and other important details. When problems do arise, make sure to keep communication lines open. Listen to what your tenants have to say, as sometimes they might be facing genuine hardships or have valid complaints about the property. Addressing concerns promptly can prevent issues from escalating. Documentation is key. Keep records of all interactions, missed payments, warnings sent, and any other relevant correspondence. This can be crucial if you need to take legal action. Always abide by the law. Know your rights and responsibilities as a landlord, as well as those of your tenants. This will help you avoid legal pitfalls and handle evictions or other serious actions correctly should they become necessary. It's also smart to think ahead and have policies in place for late rent, property damage, or other common problems. Planning how you'll handle these situations before they happen can make dealing with them much smoother. Sometimes, despite your best efforts, you might need to part ways with difficult tenants. If this happens, do so in accordance with the law and your rental agreement to prevent further complications. Throughout it all, maintain your professionalism. Avoid letting emotions control your actions, as this can lead to bad decisions. By staying calm and systematic, you'll be better equipped to manage difficult tenant issues effectively. Idea 13. Exit strategies. When it comes to exiting an investment property, having a plan is just as important as the initial purchase. Exit strategies are the ways an investor can leave an investment to realize profits or cut losses. Firstly, an exit strategy could be selling the property. This is often referred to as flipping, if done relatively quickly after adding value, or it might be a long-term sale after years of rental income and appreciation. Another approach is refinancing. An owner might choose to take advantage of increased property value or paid down loan balance to refinance and pull out equity. This money could then be used to invest in more properties or for other financial goals. Lease options are an alternative, giving tenants the right to purchase the property at a predetermined price within a specific time frame. This can be beneficial for investors not wishing to sell right away and for tenants who need time to secure financing. Owner financing is yet another exit strategy. Instead of a traditional sale with a bank loan, the owner acts as the bank, providing a loan to the buyer. This can often lead to a steady income stream from the buyer's payments. Finally, passing on the property to heirs could be an exit strategy. Some investors view their properties as a long-term wealth-building venture that they plan on leaving to their children or other beneficiaries. Each strategy has its own set of considerations regarding taxes, legal matters, and financial implications, so it's crucial to weigh up the options and choose the best fit. It is important to also note that market conditions, personal financial goals, and the performance of the rental property. These factors should all play a role in deciding on the right exit strategy. Idea 14. Real estate investment mindset. Investing in rental properties isn't just about crunching numbers and managing properties. It also requires the right mindset. Adopting a mindset suited for real estate investment involves embracing patience, education, and adaptability. Patience is key because success in real estate doesn't usually happen overnight. It often takes time to find the right deals, secure financing, and see significant returns on investments. Understanding this is crucial to avoid making hasty decisions that could lead to poor investments or unnecessary risks. Education includes ongoing learning about the market, investment techniques, and even learning from mistakes. The real estate world is dynamic, and strategies that worked yesterday might not be as effective today. Investors should dedicate time to reading books, following market trends, participating in forums, and maybe even enrolling in courses. This continuous quest for knowledge helps to remain competitive and make informed decisions. Last but not least, adaptability is about being flexible and ready to pivot when necessary. Investment plans might not always unfold as expected. Markets can shift, unexpected costs can arise, and legislative changes might affect profitability. An investor with the right mindset won't be derailed by these challenges, but will adapt strategies to overcome them and capitalize on new opportunities that arise. By adopting a real estate investment mindset rooted in patience, education, and adaptability, investors are better prepared to navigate the complexities of rental property investing and succeed in the long term. Idea 15. Tax implications and legalities. Understanding the tax implications and legalities is a key component of rental property investing. When you own rental real estate, you are subjected to a different set of tax laws compared to personal real estate. The income you earn from your tenants is taxable, but you also get the advantage of deducting various expenses related to your investment property. These expenses can include mortgage interest, property taxes, insurance, maintenance costs, property management fees, and depreciation. Depreciation is a significant benefit for rental property owners. It allows you to deduct the cost of buying and improving a rental property over its useful life, providing a way to shield a portion of your income from taxes. However, it's essential to understand how to correctly calculate and claim depreciation, as making mistakes here can lead to issues with tax authorities. There are also legal considerations to be aware of. Different areas have different laws that affect rental properties, such as tenant rights, fair housing, and property conditions. It's important to stay informed about these laws and ensure you're complying with them to avoid legal troubles. For instance, tenant rights laws may dictate how and when you can evict a tenant, while fair housing laws prohibit discrimination against potential tenants. Additionally, you should form an appropriate legal entity for ownership, like a limited liability company, LLC, to protect your personal assets from potential lawsuits related to the property. This legal structure can provide a layer of protection between your business operations and personal matters. Insurance is another legal aspect that can't be overlooked. Having proper insurance not only protects your property in case of damage, but also can protect you from liability. in certain circumstances involving tenants or visitors to the property. Overall, being knowledgeable about the tax implications and legalities in real estate investing is crucial. It can help to maximize your investment returns while minimizing your liability and ensuring that you are operating within the law. Consulting with professionals such as tax advisors and attorneys who specialize in real estate can provide you with the tailored advice necessary for your specific situation. Idea 16: the importance of networking. Networking is a key part of success in rental property investing. It's all about building relationships with other people who are involved in the real estate business. These can be seasoned investors, newbies, agents, lenders, or anyone else who has a role in the industry. When you network, you're not just collecting contacts, you're actually forming connections that can help you grow your investment career. Having a solid network means you can find better deals, learn from the experiences of others, and get advice that's tailored to your situation. Think of networking as a two-way street. You're not just looking to get something from others, but you also have to be willing to help out. Maybe you'll share a contact, provide some advice, or help others in a meaningful way. By doing this, you build trust, and people will be more likely to assist you in return when you need it. At real estate meetups, online forums, or local investment groups, you have the chance to meet people face to face. This can lead to opportunities that you might never find through an online search or an advertisement. A good deal might come your way because someone you met months ago remembers that you're looking for a certain type of property. Networking can also help you find mentors. These are people who have the experience and can guide you as you make your own investment decisions. They can share lessons learned from their successes and failures, offering you valuable insights that can save you time and money. Effective networking isn't just about taking business cards at an event. It's about forming relationships that can develop over time. It's about asking questions, listening intently, and following up with people to show that you value their time and expertise. In the real estate world, who you know can be just as important as what you know. It's these relationships that can give you a heads up on a new property on the market, provide you with inside information on market trends, and introduce you to service providers like lawyers or contractors who can help you succeed. Networking can also make the journey less lonely. Real estate investing can be challenging, and having a network of like-minded individuals can offer moral support. They can share the excitement of your successes and offer encouragement when you encounter setbacks. Starting to network can be as simple as joining a real estate investing club in your area, connecting with others on social media, or attending industry conferences. The key is to be proactive, open to learning, and sincere in your interactions. And over time, your network can become one of your most valuable assets in real estate investing. Idea 17: real-life stories. The section of the book that shares real-life stories serves as a powerful tool for readers. These stories give a face to the concepts and strategies discussed throughout the book. Think of them as a window into the day-to-day realities of rental property investing. When the book delves into these anecdotes, it shows how different people, perhaps someone just like you or me, have approached the task of investing. Importantly, the stories vary widely. We get to see the journey of the complete novice, fumbling through their first purchase, learning from their mistakes, and growing more confident. We also hear about the seasoned investor who has turned the buying and managing of rental properties into a fine art. By including the successes and stumbles of these individuals, the book makes it clear that investing isn't just a series of calculations and contracts. It's a human endeavor. Each story portrays unique challenges. Maybe it's a difficult tenant, an unexpected repair, or a funding issue. But they also reveal the critical moments of triumph, like securing a great deal or achieving a positive cash flow that exceeds expectations. What makes these stories resonate is how relatable they are. Readers can see parts of their own investment dreams reflected in the experiences of others. It's one thing to read about the principles of negotiating a deal, but quite another to read about someone sweating through their first negotiation, learning to hold firm on their offer, and walking away with the terms they set out to achieve. These narratives often present the problem-solving aspect of property investing. For example, a story might describe an investor who encounters a legal obstacle and how they creatively overcome it. It's these practical demonstrations of perseverance and ingenuity that not only educate but also inspire. Lastly, reading about someone else's journey helps to dispel the loneliness that can sometimes accompany the investing process. It's a reassurance that the reader is not alone in their ambitions or fears, and that there is a community of individuals out there with similar stories, experiences, and the willingness to share them. These stories embody the cycle of learning, action, and growth that shapes a successful investor. Idea 18: avoiding common pitfalls. When it comes to avoiding common pitfalls in rental property investing, the book identifies a set of challenges that investors might face and provides guidance on how to steer clear of them. One key warning is to not underestimate expenses. It's important to budget for all potential costs, including repairs, vacancies, property management, and capital expenditures. Overestimating the optimistic outcomes can lead to financial strain, so being realistic with the numbers is vital. Another pitfall is neglecting proper due diligence. This means thoroughly inspecting a property, researching the market, and verifying all financial information before making a purchase. Skipping this step can result in unexpected problems after the deal is closed. The book also cautions against getting emotionally attached to a property. Emotional attachment can cloud judgment, leading investors to make decisions based on feelings rather than facts. Keeping a level head and sticking to the criteria that match one's investment goals is essential. Additionally, the pitfall of ignoring legalities can be quite detrimental. It's essential to understand and comply with all local, state, and federal laws, including landlord, tenant laws, and fair housing regulations. Entering properties are up to code, and following the rules can prevent expensive legal troubles down the road. Lastly, inadequate or improper financing is mentioned as a pitfall. Rushing into loans with unfavorable terms or not understanding the full implications of different financing methods can trap investors in unmanageable debt. It's recommended to fully understand the mortgage terms and to shop around for the best financing options for one's situation. Avoiding these pitfalls is largely about education, awareness, and a willingness to approach real estate investing with a meticulous and disciplined mindset. Being informed and careful in planning and executing investment decisions can help steer clear of common mistakes and pave the way for a successful investment journey. Idea 19: the role of your personal finances in investing. Understanding and managing your personal finances is a foundational step in rental property investing. Ensuring you have a solid grasp on your own money matters is critical before you dive into investment opportunities. This means being aware of your income, expenses, debts, and credit score, as they all play a role in your ability to finance real estate deals. Having a budget is key. You need to know where your money is going each month and ensure that you're not overspending in ways that could hurt your investment potential. Minimizing personal debt, especially high-interest consumer debt like credit card balances, is important too. It can affect your credit score and your ability to get loans for investment properties at good interest rates. Speaking of credit scores, keeping yours in good shape opens up better financing options. Lenders look at your score to decide if you're a risk or not. A higher score can mean lower interest rates and better terms, which in turn could mean more profit from your rental properties. It's also smart to have an emergency fund. This is money set aside to cover your personal living expenses if something unexpected happens. Without it, you might have to dip into funds meant for your investments, or, worse, sell off investments at the wrong time to cover personal emergencies. Lastly, consider how your personal financial goals align with your investing. If you're saving for a significant personal event, like your child's college education or your own retirement, you'll want to plan how your investment strategy supports these goals without putting them at risk. Being clear on your financial situation can help you make better decisions when investing in rental properties and can ultimately contribute to your success in building wealth through real estate. Idea 20: scaling your real estate business. When it comes to growing your real estate business, the process involves more than just acquiring additional properties. It's about refining the systems and approaches you've developed and leveraging them to handle a larger volume of investments efficiently. At the start, many investors do everything themselves, which is a great way to learn the ropes. However, as your portfolio grows, so do the demands on your time. Suddenly, you're not just an investor, but a property manager, contractor, and bookkeeper, roles that can quickly become overwhelming. This is why creating systems and hiring the right team become crucial. Systems are the routines and processes you establish for running your business. This could be software for tracking your finances, checklists for property inspections, or templates for tenant communication. With solid systems in place, you can handle more properties without adding a corresponding amount of work for each new property. A team can include property managers, real estate agents, attorneys, accountants, and maintenance personnel. These professionals can take over specific duties, allowing you to focus on the parts of the business that you are best at or that you enjoy most. Building a reliable team is a step toward ensuring that your properties are well managed while freeing you up to seek new opportunities. As you add more properties, you'll also have to become smarter about financing. This might mean finding lenders who can offer better terms as you become a more established investor, or using creative financing methods to stretch your capital further. There's also the factor of risk management. As your portfolio grows, so does your exposure to potential risks. This means you might need to take a closer look at insurance, business structure, and your reserves for maintenance and vacancies. Scaling your real estate business is about working smarter, not just harder. It's about making strategic decisions that allow you to manage more properties and create more wealth without sacrificing all your personal time or increasing your stress levels.